Hello, good to see you again, figuratively speaking. Kurt with PHP here, and today I'm going to walk you through the options for receiving city funds to help offset medical costs, and how you can save your own money to plan for the same expenses. If you remember from the medical benefits video, our Summit Star plan has an HDHP attached to it. The HDHP in your plan name means High Deductible Health Plan. The city cares about its employees and wants to ensure the deductible is still manageable. It's not an extremely high deductible, $1,500 for single and $3,000 for double and family coverage. To help offset this high deductible, the city contributes half of the deductible, $750 for single and $1,500 for double and family, into your health savings account or HSA. An HSA has to be in conjunction with a high deductible health plan like the city offers. You can't contribute to an HSA unless your coverage is considered high deductible. Your HSA is an interest-bearing, tax-free savings account dedicated to preparing for medical costs. The city contributes half of your deductible on the first day of the fiscal year, July 1st. For anyone who started after July 1st, the city will prorate its contribution to your HSA based on how many weeks left in the year you will be working. For example, a single person starting in mid-May, just a few weeks before the end of the fiscal year, might expect a very small contribution of about $60 when they start. But don't worry, when the new plan year starts on July 1st, the same employee would receive $750 in their HSA to help with next year's deductible. At higher and every year after July 1st, the payment is front-loaded, rather than you getting it piece by piece over 26 paychecks. Another great part about the money the city contributes to your HSA, it's yours. Even if you leave the city, that money is yours to use for medical expenses the day it's put into your account. Although these funds are decided by the city and are not a guarantee, they can be used for medical, dental, vision, and pharmacy expenses. It's in your best interest to put some of your own money from every paycheck into the HSA. Every dollar of your own money you contribute to the HSA is tax-free, meaning you are not taxed on that income when you deposit or spend it. Because of this amazing benefit, there are maximums on how much you can contribute to the account each year. Make sure your personal contributions over the calendar year don't exceed the IRS limits, and that includes anything you might have added to your HSA in the year from a previous employer. If you're contributing at a family level, that's a per household limit. As an example, if your spouse is on another high deductible plan and gets contributions from their employer, between the city's contribution on your behalf, your spouse's employer's contribution on their behalf, and any money you both want to contribute of your own cannot exceed the IRS limit. These annual limits are how much you can contribute each year, not how much you're allowed to have in the account total. All accumulated funds, including what the city contributes, roll over and never expire. Your HSA can carry you through to retirement with tax-free medical savings. Also, any employee who is over age 55 can contribute an additional $1,000 a year above the designated IRS limits, whether single or family. Taxes and penalties may apply if they are not eligible expenses. You'll get a tax statement every year from Health Equity showing contributions and expenses. Medical providers are automatically tagged as eligible expenses, but other purchases, like over-the-counter cold medications, are eligible but are not billed to PHP. If PHP doesn't have a record of your expense, it's in your best interest to keep all your HSA receipts just in case you are audited. You are responsible for directing your HSA funds appropriately. Those are the guidelines for contributing and using the account. Let's talk about how to access it. If you have an existing HSA from a previous employer, that's okay. Our HSA administrator is Health Equity. So if you had Health Equity before, that account is tied to your Social Security number, will stay open, and transfer to your employment with the city. You would keep your same card, account number, online portal username, and password. All that's changing is the employer and how much the city contributes. So don't trash your card. If you had another HSA administrator besides Health Equity, you can pay to transfer the funds to your new Health Equity account for $25. Or if the balance is low enough, just spend down your old HSA and then close it. You may still have to pay the fee for that old account to keep it open, and any contributions to that account count towards the IRS annual contribution limit. The choice is up to you. Pause this video for a moment to review some other details about your HSA to consider. Your Purple Health Equity Card should arrive in the mail about 7 to 10 business days after you enroll. It's a very nondescript envelope, and some people have thrown it away by accident, so be on the lookout for it in your mail. Even if you have a high-deductible health plan, there are some additional eligibility rules for an HSA that could disqualify you. Pause again and take a look at the list of guidelines, and hopefully you qualify. Bring any remaining questions about HSA eligibility to orientation. If you don't qualify for HSA, the city will still deposit part of your deductible into a flex spending account or FSA. If you have an FSA from a previous employer that you want to transfer, that account has to be at zero balance before the city will deposit any funds into your city FSA. The IRS doesn't want you to have both accounts open. If there are any pending claims from your previous employer's insurance you haven't paid yet, pay those so you leave as little behind as possible before you close your old FSA account. So you can get an FSA if you don't qualify for an HSA, but even those who qualify for an HSA can get their HSA and contribute to a limited FSA, where you can elect up to the designated IRS limit of your own money on top of what the city contributes to your HSA. The funds you elect for a limited FSA are pre-tax. The limited in the title refers to the fact you can only use this account to pay for dental and vision expenses. Note, funds in either FSA account do expire. It's not like an HSA where the funds roll over and carry through to retirement. FSA funds must be used by the end of the plan year or you lose them. So even though you can contribute to an FSA pre-tax, don't contribute more than you think you'll use in a plan year. Anyone with an FSA or limited FSA will get their MasterCard in the mail in the same time frame, about 7 to 10 days after enrolling in the benefit. This ensures that the funds are kept totally separate from the HSA in cases where someone has both. There's a couple of tax stipulations about the account you may want to consider if you have dependents. You can only use HSA funds for your dependent children if you are claiming them on your taxes. If you don't claim them on your taxes, they can still be covered by your plan and count towards deductible. You just can't use the HSA funds. FSA funds, it doesn't matter. You can use those funds for your children regardless if you are claiming them on your taxes or not. That covers it. After this video, you should be able to define the city's contribution and your own contribution limits, compare and contrast HSA and FSA, and finally, describe how a limited FSA works with an HSA. If you're not sure you qualify for an HSA, FSA, or limited FSA, or how much you should contribute, please ask your questions at orientation or take advantage of the free PHP consultation mentioned in the Access to Benefits video. We're here to help you. See you soon.